All right, good morning, everybody. I guess on this side of the world, it's the morning. Maybe for many of you, it is the afternoon or the evening. So good evening if that's the case. My name is Pascaline Dupas. I'm a professor of economics at Stanford University, and I'm going to be teaching the lectures today, lecture 6 on savings, behavioral barriers. That's the 6th lecture in the second module of this BRED open course on development economics. I'm going to get started now. If some people join a bit late, hopefully they will be able to join right along. All right, so let's just start with a little recap of where we are. Since we started this module 2 on credit, insurance, and risk, what have you been hearing about? You've been hearing about something that's very obvious and well known, which is the fact that income fluctuations are ubiquitous in low-income countries. That's in part because income often comes from agriculture, but agriculture has a lot of variation across years and also within years due to weather patterns. And another fact is that many people in low-income countries are self-employed. When you're self-employed, if you are sick one day and you cannot go to work, you cannot go tend your business, you can go to the market to sell your goods, that means essentially no income for you that day. That may even mean that you lose, let's say, value if you had an inventory of vegetables you had to sell and you can't sell them and they rot. Okay, so income fluctuations are particularly frequent in low-income contexts. They're also particularly problematic because when you start with very low consumption, any drop further in consumption can be extremely costly. So if you're at the part where the marginal utility of consumption is extremely high because you don't have very much consumption, any drop is extremely costly in terms of what we economists call utility. So key question is, how do people maintain consumption in face of fluctuating incomes? And you may recall from the very first lecture in this module by Chris Udry that there are different ways through which people try to both mitigate the risk. So that means try to limit how much their income fluctuates, and ways through which they cope with risk. So they cope with a shock to their income. So on the mitigation side, you can say this is what happens, prior to the realization of the shock. What can you do in terms of your income and production? And these are things that we did not cover in this module, but are very interesting topics on which there is a lot of literature. You can try to enter in shared tenancy contract where you share the risk with the landlord. You can try to make irrigation investment that are going to limit the extent to which your income is affected by fluctuations in income. You may try to diversify what you grow on your land so that you have some crops that are maybe more resistant to drought than some others, or that would be affected differently by different weather patterns. You may try to diversify which occupations you do. You have multiple things that you do at the same time, or within the household, someone is in agriculture, someone is not, so that you can pool risk that way. Or you can just focus on taking up low risk activities, okay, activities that have the least face the least risk. So for example, you may invest primarily in drought resistant crops, even if that means that they are not very high return, but they are the ones that are going to limit the risk. So all of this we are not going to discuss at all, but this is very interesting ways to think about how people can mitigate the risk ex ante. And what's tricky here that often these choices may actually lead to lower average income. So you have to trade off a reduction in risk with a reduction in income. What has been more the focus of this module is trying to think about the ways through which, prior to realization of the shock, you're going to try to make sure that your consumption is going to be more smooth than your income, and that you can do through insurance or saving, or through what we can call location diversification, where you may marry your children far away with villages that face very different shocks than yours, so that you can pool risk that way, or you yourself, you migrate somewhere, some of your household members migrate somewhere. And so when you want to do this insurance or saving methods to smooth your income, you're going to have to do that, start, even before you have a shock, you have to invest in insurance or you have to invest in savings, so that after the shock has been realized, that's when you can, take advantage of this and get your payout from the insurance, or sell your assets, de-save, in order to cope with the shock. Okay, and you're gonna have to do that in particular in contexts where borrowing is not going to be an option. Okay, so in case you didn't save in advance of the shock and you face a bad shock, if you can borrow, maybe that you're fine, but you're not going to be able to borrow. If you're not going to be able to borrow, then this saving mechanism is going to be all the more important. So what you've seen so far, starting with the first lecture by Professor Udry, is that there's a lot of informal insurance, but there are limits to informal insurance because of moral hazard and limited commitment. People typically can only insure each other if they know each other quite well, and so that means that informal insurance is not going to work very well against aggregate shocks, which require putting risk with someone further away. And so in practice, informal insurance mechanisms are only going to go that far. So you really need kind of like formal insurance in that case. Formal insurance, which would be through a formal insurance company that can pull risk from many people that don't know each other. But as you've seen with the lectures by Professor Casaburi, that's actually pretty hard as well. There is adverse selection, there are transaction costs, risk of fraud, issues of trust, there's this like basis risk problem, etc. So it's often the case that take-up of insurance, formal insurance is quite low when it's available, and in fact, it's rarely available because what's financially viable for an insurer is often not attractive to those who need the insurance. Okay, so in this chart here, I've told you, well, you can use insurance, but okay, insurance doesn't work that great. You can also use borrowing, but what you've also seen from the lecture by Professor Banerjee is that access to formal credit is actually quite limited. There's evidence of credit rationing and credit constraints. You're going to hear more about credit next week with Professor Breza, looking in particular at the extent to which microcredit has been able to step in and deal with these market credit failures. But on the whole, still many people don't have access to credit. So that really leaves saving and de-saving as the one potentially or theoretically easiest way for people to deal with shocks, to smooth consumption against shocks. Why? Because in principle, that's something that you don't need a market for. Okay, you can just do that on your own. It's just you and your mattress, your pillow. You can save under your mattress and then de-save when you have a shock. So you don't need anybody to trust you. You don't need to trust anybody. You can just do that, okay, in the face of uncertainty. So that's what we're going to look at today, the extent to which people are able to do that. And we're going to see, to start, that some empirical evidence that people have difficulty saving. And we're going to illustrate that point with, there's some very fascinating data that comes from a paper by Carol Muller-Nathan and Ross, published in AR Insights 2019, about a debt puzzle. The fact that people seem to be, in some contexts, in great debt, even though they could get out of debt fairly easily if they just saved a little bit every day, and they seem to have difficulty doing that. So after this empirical illustration of this kind of puzzle, we're going to think about how to modify the standard model to allow for self-control problems. So yesterday with Professor Udry, you saw kind of a standard model of for saving, and so the Euler equation. We're going to see how we need to modify that to maybe allow for people to have behavioral barriers to savings. And then we're going to go back to some empirical literature and look in particular at ROSCAs, which is something that Professor Udry mentioned yesterday. ROSCAs are these rotating savings and credit association that people use to save in groups and borrow from each other. And we're going to see the extent to which they actually could, their design, which is very very common across many countries of the world, seem to be well set to deal with these behavioral barriers. And so they seem to be a quite amazing informal solution to these behavioral barriers. But then we're going to go further and try to tease out the various behavioral barriers, and especially, what's the role of self-control in particular versus some other types of barriers. And we're going to look at that by doing a deep dive into three papers. I've just picked those three because, either I'm very familiar with them already or I just like them a lot. There are many other papers on this topic that I like a lot that I didn't have time to put in the slides. So, at the very end, I'm going to give you some kind of links to, some papers or review papers that can help you go through this vast literature on savings, especially commitment savings, if you're interested. Okay, I'm just cherry picking here a few things just to illustrate how, especially through these three papers here, used field experiments to kind of like tease out mechanisms. So I picked those three just to illustrate what can be done with this type of methods to make progress in thinking about the type of products that could help households achieve the saving level that they want. Okay, so I'm gonna just take a sec here to check if there are questions. I see there are no questions. Please feel free to put questions in the Q&A when you have any, and I'll try to address them when I can. All right. I also like to ask questions from students, so I cannot see you, unfortunately, but I may still ask you questions. There are not very many of you. It's only, about 30 people in the audience, so maybe we can actually have a little bit of a conversation. I may ask you questions, and hopefully you can answer them in the Q&A. Okay, so let's start with the debt cycle puzzle. Okay, so as I mentioned, this is a paper by Karen, Middleton, and Roth, where they actually the date is wrong here. Sorry, it's 2021. They have data. I mean, in their paper they have data from both India and the Philippines, but I'm going to focus here on the numbers from India. So they have data from vegetable vendors in Chennai, and these vendors have a very simple production function. In the morning, they go purchase fruit early in the morning from a wholesaler, and then they go to the retail market and they sell throughout the day. Okay, and then they go home, and the next day they do the same. Okay, the average working capital outlay of those surveyed was just about 2,000 rupees, or $45 at the time, and the average profit is 220 per day. Okay, so just above 10%. Okay, so they essentially invest 2,000 every day at the wholesale market, and then come home with 2,220. And many of them take loans daily. Okay, 40% of these vendors, in the morning, the first thing that they do actually, they when they go to the wholesale market, not only do they, before they actually buy their products, they first borrow 1,000 rupees. Okay, and then they have to pay back at the end of the day. And the interest rate on this is 10%. And people have been doing this on average daily for 10 years. So for 10 years, every morning they first borrow 1,000 rupees so they can have 2,000 to invest in their business, and then at night they pay that back. So what is 10%? A 10% interest rate on a daily basis? Is that big or small? Someone want to type an answer in the Q&A very quickly? Is that big or small? 10% interest rate? No one wants to venture an answer? Okay, here I see one. Yes, it's big. It's big. It's absolutely humongous. Okay, it's 10% is a huge, crazy, huge interest rate. How do we see that? Well, imagine, the best way to see this is to imagine what would happen if you actually put aside just one of the 120 rupees that you earn. So why do I say they earn 120 rupees every day? Their profit is 220, but then they have to give back 10% of the 1,000. So they have to give back 100 every day. So they only take home 120. Okay. So they take home 120. In terms of income for themselves. If out of this 120, instead of using it all for consumption, they saved 1 rupee, okay? And that 1 rupee they use for their business the next day, which means that the next day they can they only have to borrow 999 instead of 1,000, Okay. Well, then at the end of the day, when they have to repay back that loan, they save 0.1 rupee in interest expense. Okay. And so the question is, if I save 1 rupee a day that way, how many days is it going to take me to have saved 1,000 rupees? And the answer is much less than 1,000 days, much less than 1,000 days. Okay. So to show you that, I'm gonna, we're gonna go through a worksheet. I'm gonna have to share a different document with you. Here it is. Okay, so I put in the spreadsheet the numbers. So you start with a loan of 1,000. Okay, you have to pay 100 interest rate as a 10%, and so then you decide to save $1. Okay, so that means that the next period your loan is only 999. Okay, so your interest rate is lower. Now it's only, the interest rate is the same, so it's 10%. But now 10% of 999 is 99.9. Okay, so you save 0.1. So it looks very small. You're like, why is she telling us it's a big deal? This is very small. Yes, it's small the first day. So your total savings for that period is 1.1 because you save 1, and then you save also the 10 cents less interest. So now your total extra fund that you have is 2.1. So that means that the day after that, okay, I'm going to copy this formula. This formula is just telling me that this is this amount here minus my total savings stock, right? So now I can copy this, and every day, what's going to happen? So the next day, you only have to borrow 997.9, okay? And now you save in one rupee again. Now your interest rate has gone further down by 0.2, okay? And so you keep doing that. You keep doing that. Already you see, okay, after 10 days, you've already saved 15, okay? And so if I keep, copy my formula all the way down, okay, you can see how long does it take to actually have saved 1,000. And it takes, here we are, 1,000, it takes only 49 days. It takes only 49 days. Okay, I see there's a question. Let me check. Would lenders be willing to actually lend less than the full amount? Maybe they would find that it'd be too much of a hassle and not finding profitable at the same rate. That's a very good question. It could very well be the reason why this is not possible. So we're going to think about that as one possible explanation. That, obviously, for the lenders, doing this is highly profitable. So maybe they say, no, I'm sorry, I only give loans in sizes of 1,000. 999, that's not possible. Okay, so that could be the explanation. Maybe they don't want to do that. They only want round numbers. So, okay, fine. Then I need to, I can't do that. I need to save one myself every day without being able to borrow less. But then maybe after I've done that for 10 days, I can now say, no, I want a loan of 990. Okay, so if you think that there are some this rounding constraints, but that's something we're going to think about whether it could be the case. But first, I want everybody to see this is the power of compounding. Okay, compounding interest. It's incredible. I mean, I never remember this number. The fact that it only takes 49 days by saving $1 rupee a day to have essentially saved 1,000. I never remember this number. Each time I have to go back to this spreadsheet and do it again. Okay, so it's just like compounding is just this amazing thing that we tend to massively underestimate what it means in terms of what it does. Either when you save, or when you borrow and you have to and don't pay, and the interest compounds. Okay, so let me go back to the other slide deck. So, what I've just showed you with a spreadsheet is that, if you save just 1 rupee a day, just say, so let's say it's about the price of a cup of tea in the context, it would take even 49 days to save the entire 1,000 rupees needed for working capital. Okay, and in fact, in a spreadsheet, I didn't have time to show you, but if I had put that they were saving 5 rupees a day instead of 1, it would take just 33 days. And if they save 10 rupees a day, it would take 27 days. Okay, so, so in 49 days, you don't have to borrow anymore, okay? If you save one a day. And that means that once you don't have to borrow, you double your income because you don't have to pay back the interest, okay? So if you make 220 profit, you keep all of it. You don't have to keep 100 of it back. So you keep 220 instead of keeping 120. So that's like almost doubling your income. Okay, so that seems like, instead of doing this daily borrowing for 10 years, why don't people try to save $1, 1 rupee a day, so that after 49 days, they don't have to borrow and they double their income. They can get out of poverty that way. Well, as you know, you mentioned, one of you mentioned, sorry, I think it was Jose, it could be that there is lumpiness in loan sizes allowed by the moneylenders. And so, that's one possible explanation. Okay. But I don't know if that's the case. Maybe some lenders are like that, but then there should be some competition among lenders at some level. You would say, well, why, if one lender doesn't want to do this, maybe I can go to another one and say, well, please, I'll borrow from you if you allow me to borrow a little bit less. Okay. Now, maybe this competition among moneylenders is not there because moneylenders have some other roles. Okay, so maybe in fact, they are the wholesaler. They are the wholesaler from whom I buy my fruit, and maybe they have monopoly of the supply. So I cannot go to somebody else because if I don't borrow from the wholesaler doesn't sell me the fruit, and then there is no one else I can buy from. But again, here is then a puzzle that is not more competition. And if you make so much money, and this moneylenders make so much money from this, that it's a very profitable business to be a moneylender. So you would expect more entry and competition among more wholesalers. Okay. So again, I'm not saying that there is no market power that these moneylenders have. Most presumably they do. They may also, you may need them. These moneylenders, they lend to you when you have a bad shock. So maybe the reason why I'm paying this crazy interest rate every day is because when something really bad happens, I know this moneylender is gonna just like let me borrow even if I cannot repay right away. Okay, so that may be the reason. The fact that there is not other lower cost means of borrowing for these folks is highlighting the fact that definitely the credit market is not working well. But the question we want to think about today is why can't people save their way out of this? Okay, since we've done the math, just 1 rupee a day out of the 120 that they can take home. Why is it so difficult for people to save? So, it could be that they live very, very close to subsistence. Okay, so this 1 rupee, cutting that consumption, it's not cutting a cup of tea. People don't have the means to actually have a cup of tea a day. It's cutting something that's super important. It's like, removing the salt from the food, which, not only is which is very important for your health. So it's, money that's going to somewhere that's like very important. And without that, you would just be, below subsistence. So that it could be people are too close to subsistence and they can't save. Maybe people lack a safe place to save. So you save this 1 rupee, but then what happens to it? Well, in the story I told you, you immediately reinvest it in the business. So it would be kind of like surprising that in that like 1 rupee a day might only have a hard time. Maybe if we have the problem that Jose mentioned, which is that you can't just borrow 999. You have to wait until you've saved at least 10 to borrow 990. Well, then for these 10 days, you need a place to keep your rupees that you've saved. Maybe there is no such place. Maybe if they're going to be taken by somebody or something like that. And in fact, Chris Udry yesterday mentioned some of my own work with Jonathan Robinson, where we did one of the early studies that provided people with formal bank accounts and found that for at least some people, having a safe place to save, like a bank account, even if it's a fairly crappy bank account that actually charges you interest rather than paying you interest on your savings, it was valuable for at least some people. Okay, so maybe there is an issue of people not having a safe place to save. Another could be, well, I don't have a safe place to save because I cannot agree with my spouse as to what the money should be saved towards. So maybe I can save 1 rupee, but then if my spouse says, well, actually, let me take that rupee and go spend it on something that I don't value as much, maybe that's just not the right way to go. So this lacking a safe place to save, that could be, also just intra-household dynamics making that complicated. And one other possibility is the lack of self-control. So the fact that I really would like to save this $1, but on the day, it's 5 a.m. I'm like walking to the wholesale market to buy the goods, and I absolutely need to stop by and get a samosa because it's tough, and it's very tempting to eat something nice in the morning when you just got up. I can tell you because I had to get up early for this lecture. It's 7 a.m. for me on the West Coast, and it would have been very difficult for me to start this lecture and this day without having some nice food, and in fact I have my nice coffee. So what do we mean by lacking self-control? That's what we're going to do next. Okay, so we're going to think about how to modify the standard model to allow for self-control problems. All right. Any questions? No. Okay, so I'm going to continue. So remember the basic Euler equation for someone borrowing at the rate R. The marginal utility of consumption today is equal to the value, the discounted value of the marginal utility of consumption tomorrow. Okay, I see there's a question. Do they know about the math that they don't need to save? Oh yeah, sorry. So this is a question, but Yedil Khan asking about whether these vendors know about the math that they don't need to save 1,000 days. So yeah, you're right. Probably they don't. Probably they don't, because if ourselves we need the spreadsheets and Excel to get convinced, it's probably tricky for someone to realize that. So that would be something that would be kind of like very interesting to do, which is to like show the math and see if that changes people behavior. In the paper that Caroline et al. Have, they did not quite that, if I remember correctly. Instead, they kind of bailed people out of debt. So they gave people the money, the 1,000 rupees, so they didn't have to be in debt. And they look at whether people manage to stay out of debt. And it's very interesting. People do manage to stay out of debt for a while, but at some point something bad happens, a shock happens, and then they fall back into debt. And then they are, it's very hard for them to get out again. But if I recall correctly, I don't think that they've done this financial literacy telling people how to. But there are many other studies that have looked at the impact of like informing people or like educating people about compound interest with mixed sets of results. Yeah, that was a very good question. Thanks. All right, so let's go back to the this debt puzzle. This debt puzzle is a puzzle for the standard model. So because the basic intuition behind this equation is that people can always borrow less and finance out of their own consumption. So for them to want to borrow at a rate R, it has to be the case that the marginal utility of consumption today satisfies this equation. Okay, and so when you see this, you say, well, so if I have very high interest rate R, okay, what does that imply? Well, either delta, so this discount factor has to be super low, okay, which means I discount the future very heavily, okay, or U prime of CT plus 1 has to be super low, okay, because if this number is very, very high, okay, for this thing to equal that, either this has to be very low or this has to be very low to compensate. And what does it mean that U prime of CT plus 1 is very low compared to U prime of CT? It would mean that you have, consumption growth, okay? Because you see, the utility function, the less you consume, the higher your marginal utility. And typically we have this, concavity. And so when you consume more, you have a lower marginal utility. So that, for people to expect, a very high consumption growth, it has to be that the returns to capital are very, very high. Okay, so it could be that the returns to capital are so high that it's definitely worth it for me to borrow, because with that money I borrow, I can get much more income, and then in the future, my consumption level is going to be higher. Okay. But it's not doesn't seem necessary to be the case in the context we were looking at. So, given this other equation, the fact that the pool in the Caroline et al. Paper, so that was data from India, but that I shared, but there is also similar evidence from the Philippines, the fact that people, these folks borrow at super high interest rates imply either that they are very, very myopic, very, very impatient, so that the delta being super low. Okay, I see the question. Oh, no, okay, that was not for me. Okay. Or they cannot cut back consumption because they would starve otherwise. Or they are very quickly becoming non-poor, okay? Or they don't understand compound interest, okay? Which is, the question that was just asked, okay? That's under the standard model, okay? Now, maybe the standard model does not hold, okay? So let's think of how we can modify this so that maybe we can and introduce some what we're going to call a behavioral barrier that could provide another explanation for this. So what we're going to introduce is what's called the beta delta model, which Chris you mentioned yesterday briefly, which is also often called the quasi hyperbolic discounting model. And just to illustrate how that works, imagine you had a choice between $1,000 today or $2,000 in 1 year. What would you choose? Think of it for yourself. Okay, what would you choose? Would you give you 1,000 today or 2,000 in a year? Okay, you've made your choice in your head. Okay, now imagine that the choice is between $1,000 in 6 months versus $2,000 in 18 months. Okay, so now what would you choose? All right, you made your choice. Okay, so if you were patient for the second choice, and by patient I mean for the second choice you said that you'd wait 18 months, okay? But you were impatient in the first choice, which is, you'd rather have 1,000 today than wait 12 months. Then you are what we call time inconsistent, okay? And so what does it mean that you're in time inconsistent? It means that when you're weighing, today versus the future, you have a preference for today, but when you're weighing 2 periods in the future, you don't give some preference to what's near to you, okay? At the same rate as you do when it's about today, okay? And so what this means, if you have these preferences, what this means is that, if you face a choice which is that, okay, now you can put money in a bond that's paid off $2,000 in 18 months, but you can actually withdraw after 6 months for $1,000. From today's perspectives, it sounds like a good deal, and you're gonna, if you chose option 2 in this question here, you would definitely say, okay, I want to put my money in that bond, okay, but what happens in 6 months? In 6 months, it's today from the perspective of the person yourself from 6 months from today. And so if you're time inconsistent, most likely when 6 months hits and you are now allowed to go and withdraw your money, you are going to do that because you're like, oh, now you're actually facing the choice of 1,000 today versus 2,000 in 1 year. Okay, and if you've made that choice here of 1,000 today, that's the choice you're going to make in 6 months from now. Okay. So, the logic of this is to say, well, you're patient in the future, yourself of today, is impatient now, but thinks that, you're going to be, wants to be patient in the future. Okay. So you say, well, I'll be good later, but for now I want to spend. And it's very similar to, people want to quit smoking, and I'm going to say, well, okay, tomorrow I quit. Today, my last cigarette, but tomorrow I quit. Well, most likely when tomorrow comes around, you're gonna be like, okay, tomorrow I quit. Today's the last day, tomorrow I quit. So, you can always plan to quit tomorrow, but at some point tomorrow becomes today, and then your resolve may break down, okay? So, see, I'm trying to get this, how do I answer live? Okay. I'm trying to handle the question box. Okay, so so that's the way we model this is with this beta delta. So what is beta? What is delta? Well, remember the delta is when when you're time consistent, we say that, you have some discount rate delta, which is, the discount rate that applies between one period and the next. So if you, what we call rational with your time preferences, we assume that the utility can be written as, my utility of today plus delta the utility of tomorrow plus delta to the square the utility of the day after, etc., etc. Okay, so you apply this delta factor in between any two periods. Okay, and so what that means is that, if delta is 0.9, it means that from the point of view of today, 1 unit of utility, in 1 year is equivalent to 0.9 utility today. Okay, so I kind of like discount the future. And if it's in 2 years, then it's worth only 0.9 to the square, which is 0.81 today. Okay, so that's, we definitely discount the future. That's why, we are all collectively, polluting as much as we do, and we do many things that, like, if the consequences happen 100 years from now, we absolutely totally ignore it in most cases. Okay, so there is no doubt that we all discount the future. But if you do that in a consistent way, with the same, delta factor across any two period, that's called being time consistent. Okay. Now, quasi-hyperbolic discounting, what we were discussing when we were talking about this 1,000 versus 2,000 and choosing different choices depending on the time frame, is when you have instead this added beta term. Okay, so you are thinking about your utility from the point of view of today. Your utility is what you get from consuming today, plus when you think about the future, you apply this factor beta to everything that in the future. Okay, and then on top of that, you have this delta thing that applies exponentially. So imagine that beta is 0.5 and delta is still 0.9. Then 1 unit tomorrow is now worth only 0.45 today. Okay, because you're applying this 0.5 times 0.9 here. Okay, so that's a framework where, like, there's a case where you're always today always has a very, very special importance. Okay. But what's interesting is that when you're going to decide between allocating consumption in 1 year from now versus 2 years from now, now the only difference between them is this delta. You just apply delta. There is no additional beta factor here. That's like informing this allocation choice between a year from now and 2 years from now. Okay. So that's what time inconsistent means. That's why we say it's inconsistent, because you make choices today, assuming that you don't have a special preference for a year from now versus 2 years from now, beyond the standard delta discounting, even though when the time comes and you are a year from now, yourself of a year from now will now be in that position and will apply the delta factor. Okay. So the trade-off between periods depends on whether it is now versus 1 year or 6 months versus 18 months, or 2 years versus 1 year. Okay. And so why does this matter? Well, there's this very nice paper by Benajim and Nathan from some time back now that says, well, if there is at least part of our consumption set for which we exhibit this type of time inconsistency, then we can actually understand why it may be particularly difficult for the poor to save. Okay, and it's going to be an explanation that doesn't say, well, the poor have this beta thing and the rich don't, because that would not be a very good explanation at all for the world, because from introspection, everybody is time inconsistent for some things and time consistent for others. Okay, so instead, this is a model that's going to say, well, we can all have kind of the same preferences, but being poor is going to matter for the relative weight of different things. So let me go through that model to make this point clear. So you're going to have two periods and two types of goods, Z and X. And for consumption goods X, there is no time inconsistency. But for consumption goods Z, that's when you only value it for today. Okay, so it's some extreme form where like when I think about a cup of tea, a cup of coffee, like right here, my cup of coffee, right now I need it very badly. So, I'm going to be willing to like spend a lot to have this cup of coffee. But if I think of myself of tomorrow, maybe I'm like, no, I don't think that's, myself of tomorrow will need coffee. I shouldn't be planning on that. Okay. So your utility in each period is this, U of X plus V of Z. And when you decide how to allocate, your income between consumption and today and consumption tomorrow, and so indirectly savings and stuff like that, that's what you are looking at. You're looking at the utility of consuming good X today, the utility of consuming good Z1 to Z today, because that's you care about that today. But then when you think about the future, you have this delta factor that's applied, but then you only care about the consumption of X goods. Because from the point of view of yourself of today, you really don't value consuming Z good in the future. So you say, no, I don't want to, to waste any money on Z good in the future. Your income in each period is going to be Y, and you have an initial wealth of W naught, and then you face an interest rate R. So the standard equation that you've seen many times is again written up here. But when you have the Z goods now, okay, what the paper shows is that you now have a different other equation where what's going on is that as if your consumption, your whatever income you transfer to the future through savings is going to be taxed by temptation. Okay, so you have this factor 1 minus Z prime of CT plus 1 that's applied to the marginal utility of consumption tomorrow. Okay, so it's because the whatever you save for tomorrow, you correctly anticipate that yourself of tomorrow is actually gonna want to spend on this temptation good. But from the point of view of today, you don't think that's a good thing to do. Okay, so you anticipate that if you save, some of it is gonna be wasted on these goods, and you're like, well, no, I don't see the point of that. Okay, so the fact that I anticipate that my future resources will be wasted on consumption that I do not care about from the point of view of today, is what's going to lead people to think hard about how much they want to save today. So I could be completely naive about that. So it's all right. Not sure what happened here. Get disconnected. All right. Can you hear me?
Yeah.
Can I get a? Oh, okay. Sorry, I don't know what happened. So I don't know where you lost me. But does anybody want to tell me where I was when you lost me? I was talking about sophistication. So, if you're sophisticated, it means that you anticipate this. You correctly know that there is this inconsistency between yourself of today and yourself in the future, okay? And so if I'm sophisticated, I'm going to anticipate this tax on spending. And so I'm going to actually be like, well, there is not that much point in saving, because if I save too much, my future self is going to waste the money. So I'm going to be less forward-looking because of that. I anticipate the waste in the future, so I'm going to be like, well, there's not as much need to save. Okay, so if I could tie the hands of my future self, if I could like sign, a contract that would be enforceable, saying, whenever I try to buy, some cookie from the store, I should be prevented from doing that, and no, cookie seller anywhere in the world should agree to sell me a cookie ever. Maybe you can prevent this temptation, but if you don't have the means to completely commit not to spend anything on this Z goods that you won't value that yourself of today doesn't value for the future, then you're going to anticipate this tax and save less. Okay. So, what's different here from the standard theory is that now there are two forms of myopia, delta and Z prime. And so you can explain the earlier puzzle, this debt puzzle, without needing the poor to be more impatient. So we don't have to say, oh, it's, the poor have a lower delta. Everybody can have exactly the same delta. Instead, what you need is for the poor to have a higher Z prime, okay? And so what's really great about this model that it says that Z prime can just vary systematically with wealth and thus with consumption. And so the idea here is that, well, if consumption is non-declining, so it's this Z prime is constant. That means that the rich and the poor face similar time inconsistency problems. Okay, and then you can even have the standard case where Z prime of C is 0. But what's most likely that there is satiation, which means that Z prime of C is declining. Okay, so what does it mean? Well, you only need that many cups of coffee a day. Okay, so maybe it's super super tempting to have a cup of coffee a day, but the second cup of coffee is not that needed. And the third, you can definitely do without. So, if you're very poor, just one cup of coffee a day is going to be a much larger share of your income than if you're rich. Okay, so the size of these Z goods relative to your total income is just going to be smaller if you have satiation. Okay, a lot of the stuff that we think about that we are tempted to have, we don't need a ton of it. Okay, so I mean, ultimately it's an empirical question whether or not the temptations decline. You could say, well, but we know of all these rich people who buy fancy cars that are useless, that they can go like 200 miles an hour, but there's no highway that allow you to go 200 miles an hour, so who cares? So you can think of many things that rich people spend money on that seems to be complete temptation and not very valuable. But the point is that it's fine as long as this is still a relatively small share of their income. So very rich people who waste money on all sorts of stuff that we don't think are valuable, it's still a very tiny share of their income. That it can be spent on temptation. So that's what's going to matter is the extent to which you think your future income will be taxed by this temptation, and it's kind of like you want to think in terms of relative to your wealth. So what's very nice about this model that it kind of like generate these poverty traps. Okay, because if you're poor to start with, okay, that's when you're going to face just the fact that we all need a cup of coffee a day. That's going to have much more bearing on the very poor than on the very rich in terms of generating this tax on your future savings. So, what does this give us, this framework? Well, it gives, first of all, also besides this poverty trap, it gives an aspiration effect. So when the future looks better, people might save more, okay, because they anticipate a lower tax. So if I think I'm going to have, a windfall of income in the future, then actually the returns to savings are higher. Let me see, there's a question. Is the assumption that everyone is sophisticated? They know that Z prime of C is. Yes, so here we're assuming if you're sophisticated, you do that. If you're not sophisticated, you wouldn't have this you wouldn't anticipate this tax, so it wouldn't have this effect. So this in this model, if people who are sophisticated are the ones who actually end up saving less. Okay. So what does this framework give us? So aspiration effect. Okay. So which means that you can save more if you anticipate things are going to get better in the future. It also means that maybe people want to have don't want to have liquid savings. Okay. because liquid savings is what you can most easily use for this temptation spending. So you don't want to, saving a rupee in cash in your pocket. That's like fire in your pocket. So you can't do that. That's when you're going to spend it on the cup of tea. So you only want to save in let's say like durables, and that means that's you're going to have to use durables to smooth consumption. And then it's also going to generate a demand for commitment. Okay, you're going to see, I think, with Emily Breza next week, that sometimes people seem to be taking on microloans from microfinance organizations, primarily for the commitment to repay installments. Okay, so like the disciplines that I get from a money lender, like the microfinance officer coming to my house once a week, or coming to my group meeting once a week and say, hey, time to pay up. That's the commitment to actually save in a way. So people would then participating in microfinance not for the credit but for the commitment to save. It may also lead excess purchase of durables, okay, because that's the form of saving that is least likely to be taxable by this temptation good, or participation in ROSCAs, okay. And so that's something that I wanted to spend a little bit of time on, is ROSCAs, because it's a very common form, very commonly used kind of like informal mechanism that people have to borrow and save. And so I just want to go through that model a little bit and think about the extent to which it's well tuned to deal with this potential behavioral bias that you can call self-control, but I think the model of Banerjee and Manhattan that talks about it in terms of like this temptation that's like declining in wealth is a better frame for it. All right, so I'm gonna move on to that unless there are questions on this. Okay, so ROSCAs. So ROSCA is a rotating savings and credit association. So it's a kind of like a merry-go-round where a group of individuals meet regularly. It varies. Sometimes it's once a week, sometimes it's once a day, sometimes it's twice a month. All sorts of configurations are possible. And at each meeting, everybody contributes some money to a pot. Okay, so let's say our agreement that we meet once a week, and every week we all bring 10 rupees or 1 rupee, and we put it in the pot. So let's say we are 10 and we all contribute 1 rupee. Well, there's 10 rupees in the pot every time. So who get this pot of 10 rupees? Well, there are different types of ROSCA. There are the random ROSCAs, where it's randomly decided the order in who gets the pot. Okay, so every time maybe we would draw randomly somebody who's going to get it among those who have not gotten it yet. You also have bidding ROSCAs, where you can bid. You can say, I really need the money right now. I face a shock, so I bid. I'm going to take it. I'm only going to take 9 of the 10. So you're essentially paying an interest. You're willing to take it for less than the total amount. Over the course of 10 weeks, you'll have contributed 10 rupees. So if you only take 9 when it's your turn, de facto you've paid an interest on this. But that's like the way to, this bidding ROSCAs are a way to allocate the money to those who need it the most at the point in time. And then you also have predetermined ROSCAs, which is where the offer decided beforehand. So on the first meeting, we agree, we draw an order, and then we all know when it's our turn. Okay, so I know I'll get the pot in, let's say week 4 out of 10. Okay, so if I get the pot before, week 10, it's a form of credit, because at the time I get the pot, I've not yet saved entirely the 10 rupees on my own. Okay, so that's why it's savings and credit association, because the person who get the pot last, they could have saved on their own, if you will, in principle, because they just, for 10 weeks, they put 1 rupee, they never got the money back until they put all 10 rupees, and then they get it. So they could just have done that on their own in principle. Everybody else get it a little bit earlier than otherwise. So it's a major method for saving for many very poor people around the world. It has different names in different contexts. It was fun to look on Wikipedia to find all the different names. Hopefully, if there's a mistake on my slide and you're from a country listed on this and I got it wrong, it's not the right name or it's not the right spelling, please email me and tell me. But it's quite common, and the statistics about participation suggests that it's often like half, if not more, of the population that participate in at least one of these ROSCAs, and often people have multiple. Okay, so I may be in one ROSCA that meets daily among other vendors of the market, and we put small amounts, and I'm in a bigger ROSCA that meets like once a month, where we put like bigger amounts, all sorts of stuff. So there are several theories on why ROSCAs exist. The first is, financing durable good purchases when there is no credit market. That's a famous paper by Beasley, Code, and Larry. Another one could be to protect female income. That's Anderson and Ballon. A third one is, to deal with self-control problems. That's the paper by Gugerti. And then it could be an insurance story. Okay, so very quickly, because I'm actually not doing well on time, I'm going to try to go through this. So the financing durable good purchases, it's very straightforward. As I just said, if let's say you get the pot in week 4 of 10, then it only takes you 4 weeks until you can buy something that costs 10 rupees. On your own, it would have taken you 10 weeks. So it's better than saying on your own. If you participate in a ROSCA, you can get the good earlier. So just like a form of credit. Now, what's puzzling with this explanation is that many ROSCAs have a predetermined order. Okay. So if there's a predetermined order and I'm number last, then I know I shouldn't want to participate in this, because if I'm number last, I don't benefit from the credit. I don't get things earlier than I would have otherwise. So why do I agree to this? Because there's a little bit of a risk. What if some member of the ROSCA, is a crook, and then they take the pot and then never contribute their share ever again, right? So there's a little bit of risk in being in a ROSCA. So why would I want to be in a ROSCA if I'm going to be number last and I don't benefit from the credit part? Okay, so it can't just be about the credit, otherwise it would somehow like unravel. So another explanation is that actually, based on the fact that in many countries, the rate of ROSCA participation is actually higher among women than among men. And so there's this very nice paper by Anderson and Ballon that said, well, maybe it's a way through which women can save for what they want. Okay. And so this is, building on a very, very large literature. I'm not going to go into it, but it's very interesting on thinking about the household. A lot of, so far, all the models you've seen were like the decision maker. There's another equation, and we're allocating consumption between today, tomorrow, and all that stuff. But who is making that decision? Are we thinking about the household? Are we thinking about the individual? Especially if you want to kind of open that box and say, well, actually, the household may not be a unit that just agrees on everything. It could be that the spouses don't necessarily agree on what they should spend money on, or what should be today versus tomorrow. So when you open that box and make the household, in the model, not just this, this unit block, but a collection of people with potentially different preferences, then it becomes much more complicated. And so if we move away from this unitary model and towards this, different types of models, but these non-unitary models, let's say, then you could have very interesting strategies that household members want to use to be able to achieve, their own preferred consumption basket. And so that paper says, well, perhaps women join ROSCAs to commit their household to our own savings preferences. Okay, and so they have data from a few, now like quite a while back, and they collected, the option that women are more likely to join ROSCA, that I had said before. And they say, well, essentially if the wife wants to buy something like a durable, then the husband does not value as much. Okay, so let's say it could be that the husband is more present biased than the wife, or it could be that they just don't agree on what they should spend the money on. And so, for example, one would be the wife wants to be able to help our family back home and send money to our elderly parents, whereas the husband's like, no, I don't care about your parents. I don't want you to send money to your parents. So there are all sorts of stuff like that. Well, by joining the ROSCA, the woman may commit the household to save at a higher rate than the husband wants. Okay, and so in that case, the Rosca is actually making the woman better off, but the husband worse off. Okay, so it's not clear that it's necessarily improving the total welfare of the household. But the idea roughly on the model is that I save in this Rosca, and then by the time once I've gotten the pot and I come home, I mean, one kind of like version of this is that on the way home from the Rosca, I actually buy the good. Okay, so the husband has no say, but you don't necessarily need that. It could just be that by the time I get home and I have the savings, by then, the husband is maybe willing to buy the indivisible good, because now it's like, it's consumption to the immediate consumption. So if it's a matter of the husband being more present bias, even he would be, happy on that day to use the savings towards the indivisible good because it's consumption today. Okay, but you have different ways of thinking about this, whether it's about different preferences for different goods or whether it's about different preferences over time. Okay, but the idea is that you can just essentially save more by locking the money away. There's a question by Marine. Is there any paper looking at the use of Rosca in order to avoid social pressure on income redistribution, for instance, in West Africa, where it's highly frequent? Yes, absolutely. We'll come to that in a minute. I guess it's kind of like, you can think of it as the same mechanism as this. You could say it could be exactly the same model as Anderson and Ballon. This time it's not between the husband and the wife, it's between the household and their extended family. But this time it's more like, well, the money is locked up in the Rosca. I can't, if you come to my door and say I really need money, I say, well, I can't give it to you because whatever I have today, I have to give it to my Rosca tomorrow because I'm bound to contribute to the Rosca. If I don't do that, they're going to be very upset. I'm committed to participate in the Rosca. So it can be a good excuse not to give money. And then the question is, when you actually get the pot, how do you make sure that you're not taxed on it? And again, if you can, that's actually, we can talk about that. Some Roscas have a spending agreement. So in some Roscas, not only I tie my savings into the Rosca in the sense that I can't take it out on my own terms, it's only when it's my turn to get the pot. But on top of that, when I get the pot, I actually have to spend it on what I've pre-specified. And so I actually have no, I can really tie my hands in that sense. Okay, so let me, so all of this is like, these are explanations that don't require necessarily self-control problems. The one explanation for Roscas that would be based on self-control problem is this very nice paper by Marike Guberti, where she had data from Kenya. Here again, she observes a high Rosca participation rate among women, but she says, well, it's not just married women. There's actually a very high participation rate among widows, okay? So, if women who are widows are participating, it can't really be this intra-household story of Anderson and Ballon that's at place, maybe something else, okay? And so it could be that the widows don't want to deal with pressure from others outside, okay? But what Guberti focuses on is that, in fact, even when you look at women who are married, a lot of them get money from their husbands to put in the Rosca pot, okay? And many of them, when they get the Rosca money, actually give it to their husband. So at least for a number of women, either because they are widows or because they do, collaborate with their husband on the Rosca thing, it doesn't seem to be this intra-household, disagreement story that could explain it. So instead, she says, well, look also at the fact that there's these spending agreements that are there that I just mentioned before. Why do people would want to commit whatever they save already? Like even before I have the saving, I'm already saying that I want to buy, a bed net with this. I want to buy a water filter with this. Why are they already, kind of like earmarking their funding? So she says, well, maybe it's a commitment feature. Okay. So she provides a new reasoning for Rosca participation, which is that these Roscas are a commitment device to solve this problem of primary hyperbolic discounting we talked about before, which is, on my own, I really want to save towards this bed net, but it's really hard, every day to keep a little bit of money. And that's why a lot of people say it's hard to save alone. But when you are in a group, if you've committed, I've committed that every day I'm going to put $1 in the pot. If I don't show up at my Rosca meeting to give the dollar in the pot, all the other Rosca members are going to come to my house and say, hey, Pascaline, what's up? You're supposed to put $1. We've all, put in $1. You've committed. Like it seems it's unraveled if you don't contribute. So there's a lot of social pressure once you sign up. There's a lot of social pressure, and you can't easily renege. These are the people you interact with, on a daily basis or on a weekly basis. There's a lot of evidence showing that this social pressure really matters. You need your friends, you need your network to help you in many ways. And so if you let them down on that one, that's very very risky. So so that social pressure is going to help you cope, and make sure that you don't spend the rupee or the dollar on a cup of tea and instead put it in a Rosca. Okay, the last explanation for Rosca participation would be as insurance. And that's especially for the bidding Roscas. Like you save in the Rosca and then you get the money when you really have a bad shock. That's when you bid to get the Rosca pot. Now, this may be a good explanation in some context, but at least in the context of the context in Sub-Saharan Africa that I'm familiar with, bidding Roscas are extremely rare. Okay, so it's not the most common form of Roscas. And in fact, in the Gogerty paper, she shows that many women, they get the Rosca pot and then just invest it again in the Rosca. So let's say I'm in a daily Rosca, and when I get the pot from the daily Rosca, I put it in my monthly, Rosca. So that would not, that's like I said, it's not just for shocks. Okay. So insurance doesn't seem to be, at least to me, from the evidence I've seen, the primary motive for Rosca participation. But that said, that there's Roscas also allow some form of insurance on top of that. So I'm not going to go into the details, but I think the insurance part of being in a group is absolutely there, and the Rosca network is very important. But the pot itself may not be used for insurance in particular. Okay, so I'm not doing great on time. I have about 20 minutes to go over 3 papers, so I don't know how that's going to go. But hopefully I can tell you enough to get you excited, so that you read these papers on your own, and you can use the slides to help guide you through these papers as needed. So let me start with this very recent paper by Brune, Chin, and Kerwin on the demand for deferred payments, published in the ER 2021, where they wanted to understand the extent to which people have trouble saving on their own when they are paid in cash, on a daily basis. Okay, so sorry, there's a question about the Roscas. I'm going to take that one before I move on. So the question is by Owen. Is it also the case that for most Roscas, members self-select, hence providing some insurance against default by members? Absolutely. You can't join a Rosca if everybody knows that you're not reliable and you're just going to bail out. Okay, people are not going to trust you. So that's the beauty of the Roscas, and maybe you're going to talk about this when you talk about microfinance with Professor Breza next week. A lot of these microfinance organizations kind of like try to reproduce the model of these Roscas by asking people to come in groups and form groups before they can apply jointly for loans. Well, that's exactly the idea, that people have to find people who trust them to participate in this scheme. And for me to find people who trust me, I need to have behaved well, and I need to continue behaving well. So there's both a selection aspect, which is that only people who have demonstrated reliable behavior in the past will be allowed to be in. So the Roscas only have people who are reliable to start with. And then on top of that, there's going to be a monitoring effect, that once I'm in there, they can monitor me. Okay, but great question. Okay, so back to the deferred payment paper. So they did a study in Malawi, a randomized control trial. I'm going to assume that you're familiar with what a randomized control trial is. But if not, you can email me and others, and we can share resources on how to familiarize yourself with this research method. But they identified 870 full-time workers working for a large agricultural employer in rural Malawi. And what they did is that, what they randomized, and they said, to some people, they said, hey, if you want, instead of getting your money paid in cash, on a weekly basis, you can keep some of it. You can keep it, some of it at the firm. Okay, so we can hold it for you. We can put it in some account for you, and then only pay it to you after a while, after 3 months. Okay, and 0 interest. So if you leave the money with us, it's not that it's gonna, we're not gonna pay interest on it. We're not going to charge you either for keeping the money for you. It's just an option that you don't have to get all the cash every week. You can accumulate it. And for many of us, we have deferred payment. Like, it varies. Like my own salary from Stanford is paid out in my bank account every 2 weeks. Before that, I was in another university, UCLA, where they paid, once a month. It's very common, typically, for people who are wage employee to be getting their payment in lumps, typically on a monthly basis, in most commonly. But for many, many people in low-income countries, they are not. It's not the way they are paid. Often they're like casual laborers. They're going to be working on a day basis. They get paid every day. Okay, so every day you get the cash. And so that then requires the onus is on you to be able to save that. Whereas if you're paid by an employer every once a month, then this kind of like lumpiness that you may value if you want to be able to buy, in big chunks, is already embedded in your contract. Okay, and so what they find in the paper, they find very large effects on savings and on downstream durable investments. Okay. So you're going to see that from there. So they are the control group and the treatment group. So the control group are the people who, did not get that option. Okay, so they just, for them, it was business as usual. They were getting their payment, every week. And the treatment group are those who could use that option. And most people actually use that option. So when they had the option, they were like, yeah, I want the firm to keep a whole bunch of my income and not pay it out right away. Okay, and so that just before the 3 months deadline of the payout, the formal savings were much higher in the treatment group. Why? Because most people didn't have any formal savings account. So if I get paid, by the firm as every week, I don't have any formal savings. I just maybe keep it under my mattress. If I don't take the payout right away and I defer it, then it's held in the bank account by the firm, and so it's technically a formal saving. Okay, so that's much bigger in the treatment, but that's almost mechanical. That's just showing that actually the intervention, the scheme that they offered actually had some bite. But what is interesting is to look at total savings, because maybe all of this is just stuff I would have under the mattress anyway, so it's not a big deal since it's 0 interest on the account anyway. Well, no, it is a big deal because actually the total savings are different. So whatever I'm able to keep in the account at the firm, they don't pay me out right away. I manage to spend less in some sense, because otherwise I don't have as much accumulated. So this is just saying that this scheme just by itself allowed people to save more, because after 3 months they had more total savings if they had access to this program. And then what did they do with this extra money? Well, they essentially bought a little bit more of lumpy things. Okay. They accumulated more assets, and bought some materials. And 2 years after, they still had they saw significant differences in the likelihood that people had an improved roof in their house. So thanks to this saving mechanism, they were able to invest in one thing that many people wanted was to be able to buy iron sheets to be able to improve their roof, and they saw that this worked. So it's like just allowing people to kind of like save in the firm. Sorry, I'm gonna deal with the light here. Right. Just allowing people to save in the firm made this big difference. Okay, and so now the question is, well, why can't they save on their own? Is it about self-control, or is it about the fact that this is very safe, like the firm keeping my money? That's much safer than what I having it under the mattress where somebody can just come in and take it. And so they did another experiment to tease that out. They went to another set of workers, and they offered them either this original scheme, like you can save through the firm, or a different version was like, well, we give you the cash, then you have the option to take this cash and go put it yourself into an account. So I give you the cash, you're paid, and now it's on you to go walk to another room in a firm where you can now deposit it into an account. Okay, and so what they found is that when people have to do this extra effort of themselves taking the cash and go putting it in an account, the savings are lower. Okay, so this suggests that self-control is part of the problem, because part of it is like once I have the cash in my hand, it's just like money burning, and it's very hard for me not to immediately be like, okay, let me spend on this and that. So the fact that once I have it today in front of me, it's hard not to spend it, and it's hard to just go and immediately put it in a safe place. But it's not, the self-control is not the only explanation, because still a lot of people are able to do this extra piece. A lot of people actually are able to just take the cash, go put it, so they are not facing such self-control problem that they are not able to do that. Okay, and when they are able to put it in this safe place, they save more. Okay, so not as much on average as when it's done automatically through the deferred payments, but still quite a bit. So that was paper number 1, which is like a very nice way to show that essentially the this lumpiness of payments, which we take for granted in many contexts where that's we are wage employees and that's how we are paid, actually matters quite a bit. The other paper I wanted to talk about is a paper by myself and Jonathan Robinson, who's been a very long time collaborator of mine at UC Santa Cruz, where we tried to understand the barrier that people were facing when they wanted to save for health. Okay, and we worked with ROSCA participants. So back to Owen's question earlier, this is going to be a pool of people who are already selected in some sense because they were participating in ROSCAs. So as I said, many people participate in ROSCAs in the context we're looking at, but nevertheless, keep that in mind. There are people who already had been, interested enough in savings that they were part of a ROSCA. And what we randomized the type of, innovation in saving that we offered. Okay, so as a random subset of people, we gave them a very simple box, okay, like that we got made by a local fundi, a local artisan, and we added a padlock here, okay, and then we randomized whether the people who got the box got the key to the padlock themselves, so they could open it and close it as easily as they wanted, or whether the key would be kept by the NGO, and so they could only open the box and get the money in after they'd reach a special target that they would set for themselves. So you cannot see here, but there is a slit here, an opening, so they could put money in the box, coins or bills, but to open it, if they didn't have the key, they would have to wait, and then they would have to say what they want to use the money for. Okay. So that was, this lock box is when they don't have the key, and the safe box is when they have the key. This is the same box. The only difference is whether they have the key or not. And then we had 2 other treatment arms that piggybacked on the ROSCA structure. One was a health pot, where in addition to the pot that you contribute to regularly, you could create an extra pot. So the whole ROSCA would agree, okay, we want to create an extra pot for, let's say, an antimalarial bed net. So we were giving 1 Kenyan shillings a day for the main pot, and now we're going to add 50 cents for this health pot. And so once, it's just kind of like a separate pot for the ROSCA, just for this health product. Okay, so that was the health pot, and then we also had an individual version, which was a health savings account. Like you could go to your ROSCA treasurer and give an extra 50 cents a day if you want. That would be put on the ledger as something that just for you. So there's no group savings component to that, okay? And that would be earmarked for you to be able to spend on health emergency. So this lockbox idea was building on a very nice paper by Ashraf, Kalan, and Yin, who had used something like that in the Philippines to help people save in bank accounts. So like you can have a box like this, it's locked, and then you can take it to the bank, and they open it for you, take the money in there, and put it in the account, okay? That way for people to commit to saving. So everyone in our context was encouraged to save for health, okay? Because what's tricky when you're trying to look at the effect of savings products on what people do is that if you don't know what they're going to save for, and everybody wants to save for something else, then actually very hard to find, necessarily effects, because it's very diffuse, how people spend their savings. So here we're based on our previous work, we're very much interested in health, and we said, let's prime people to think about health. Let's ask them what they want to do in terms of, health investments, and then see whether they've achieved that. And so we designed these different products that so that they would vary in what features they provided. So they all provided a storage feature, the very basic safe place to save feature. But then the logbox and the health bot on top of that earmarked the funding for something special. If you just put money in my safe box and I have the key, I can use it for anything I want. But the logbox and the health bot, it was earmarked for health. And then the health bot, which is through the ROSCA mechanism, in addition, offers this kind of like social commitment and credit on top of it. Okay, so by comparing the impact of these different products, this is for preventative health investment, and this was for emergency health treatment, we can actually tease out the relative importance of these different things. Okay, knowing that there's also a control group that has nothing. Okay, and we found that in the comparison group, on average, people were able to spend 260 Kenyan shillings on health after 12 months, but this was higher in the safe box group, and this was also higher in the health bot group. And the stars here mean that this difference was significant. Okay, so the log box and the health savings account, where things were earmarked, so all the savings you would put in there, you could only use for specific health purposes. They didn't work as well. The safe box, where it was open, you could do whatever you wanted, actually help people achieve their goal, much more often. And the health bot, where there was some earmarking, because you were selling for a very specific product, but you also had the social commitment aspect to it, is what works the best. Okay, and so what we take away from this is that definitely the storage component is very important, because this safe box was only providing a storage component and it worked very well. Okay, so this really matters quite a bit. When you add earmarking, actually it works less well, because people are very afraid to lock up their money for something they are very afraid that something may come up that they need the money for, and if it's been earmarked too much, they can't do anything about it. But if it's earmarked as part of a group, then that's not as bad, because maybe my group can help me deal with the shocks through some other means. Okay, so we found that this social commitment and credit really helps. So this alone and these two things work very well, even if earmarking actually dampens investments. Okay, so this suggests that the commitment, the demand for commitment, it's kind of, yes, I want to commit so that I'm not facing pressure from myself and from others to spend the money on something I don't want. But on the other hand, it's hard for me to anticipate what I'm going to need the money for. So I don't want it to be too earmarked. Okay. So in fact, what we find, and that's a question that was asked earlier about the social pressure from others, what we found in this paper is that the lockbox actually worked quite well for individuals who were frequently taxed by friends and relatives. So if we look at the impact here separately, for people who, ex ante, who told us, yes, my relatives ask quite a bit of money from me, that's where we see actually a positive impact. So people who wanted to lock their money away to prevent having to share it too much with others, they benefited from this scheme, but not so much others. Okay. All right. So I think I'm almost completely out of time. So I'm going to have to go super fast on this last paper. There are very detailed notes on the slides, so you will be able to go through that on your own afterwards. I apologize for running out of time. It's a paper by Dupas, Kramer, and Robinson on fertilizer in Kenya. It's something that some of you talked about yesterday in questions in Chris Yuli's lecture. And the starting point for this study was that fertilizer usage in Western Kenya appeared quite limited back in the mid-2000s when Dupas, Kramer, and Robinson started working on this question. And most farmers seem to want to use fertilizer, but then they said, well, I don't, because I just don't have money. And this was surprising to the researchers, because they were like, well, what do you mean you don't have money? Because fertilizer is available in very, very small quantities. So even if you don't have enough money to use fertilizer on your entire field, you could just buy, a few, 100 grams to start with, and put it just on a little bit of your land. And then, the next time a little bit more. Okay, so think of this like 1 rupee a day saving that we started with a debt puzzle. You can do the, the reverse thinking here and say, even if I can only put, 1 rupee worth of fertilizer on my land, every season, after a while, I'll be, if there are returns to fertilizer, I'm going to be able to grow more. And so, what the paper does is say, well, what if farmers have these quasi-hyperbolic preferences that we've talked about before? Is it possible that farmers simply can't save up their harvest income until the time they need to use it on their own farms, because there's a delay between the time you harvest and the time it's time to plant again? And so if there's really a commitment problem there, then they should be interested in a commitment device. And so, the idea that they had was, if you can come to farmers right at harvest and offer them a chance to put money away towards fertilizer, are they going to take it up? And, if farmers are time inconsistent, then it shouldn't work, because if farmers are not time inconsistent, it wouldn't work, because why would they want to lock up their money? Maybe they need the money for emergencies. They don't want to immediately invest it in fertilizer. They don't know. Maybe something else is going to come up. So if I'm not time inconsistent, I shouldn't want to tie my hands to fertilizer so early. If I am time inconsistent but naive, which means I don't anticipate that I'm going to renege on myself and not actually buy the fertilizer next period, then it won't work either. Okay. Because I'm just going to foolishly think that I don't need to commit, even though I do. If I'm time inconsistent, but I'm fully sophisticated about it, then you don't have to come and offer me this deal. I'm going to do it on my own. But on my own, I will know I need to immediately invest in fertilizer after my harvest. Otherwise, the money is going to go away. So it's only if farmers are time inconsistent, but partially sophisticated, that a scheme like that would help, where you come and you say at the time of harvest, do you want to invest that money in savings? And so, so what does it mean to be partially sophisticated? Is that, well, you say, yeah, okay, I'll go get fertilizer tomorrow. I think it will be fine. But then something comes up, and so you end up having to spend the money, and you never buy it. Okay. So the key ingredients of the model, and I'm just going to give those and then stop because I'm out of time. But you have like farmers who are present biased, so this time inconsistent, but stochastically so. Okay. So each period they're actually going to be patient with probability P. Okay. And the fact that they are partially naive is because they overestimate this likelihood. Okay, so I overestimate the likelihood that next period I'm going to be patient, or underestimating the likelihood that I'm going to be present bias in the future. And it could be that either it's just my preferences are like that. Sometimes I wake up, I'm time inconsistent. Sometimes I wake up, I'm not. Or it could be that there are demands on my income, which I can't anticipate well, and I tend to underestimate. Okay, so it's a very nice model. I'm not going to have time to go through it. As you can see, there's a lot of notes here, but the bottom line is that they find that their model predicts that if you offer people a small financial incentive to invest in fertilizer early on, it's going to work for some farmers. And they find that there's a good share of the farmers in Kenya for which that helps. But the magnitude of the effect is somewhat limited. Okay, so the behavioral mechanism that they highlight in the model is a very nice model. Definitely seems to be at play, but to a relatively small extent. It cannot explain too much of why fertilizer use is low in the context. But I encourage you to read the paper carefully, because it's a very nice model. Okay, so just to wrap up, because I'm out of time. Overall conclusion of this. People don't seem to be able to smooth consumption perfectly through saving and dissaving, and also they are not able to save for profitable investments as much as they would like. It could be for very mundane reasons, like the fact that inflation makes cash savings costly, and saving in assets is lumpy and risky as well. But the main takeaway I want you to take from this is that this difficulty to save is not necessarily because people are too poor to save. I mean, obviously some people are too poor to save, but not everybody. some people are not too poor to save, but they lack access to financial products that help deal with temptations, and temptations can be pressure from others or lack of self-control. But the key point is that these temptations, because of the association, are going to be, differentially impacting the very poor, not because they are more impatient, but because the relative role of these temptation expenditures in their consumption basket is going to be greater. And all of this is not actually specific to low-income countries. There's a lot of evidence from the US, for example, and other contexts that have higher income, that without sophisticated financial products, people undersave. Okay, so there's a famous Save More Tomorrow experiment in the US showing that people undersave for saving for retirement. Okay, so just to completely end here. The lecture was too short. 90 minutes is way too short to do justice to the vast literature on commitment savings products. And there are many fascinating RCTs that have been done on this in the last 15 years. There are mixed set of results. Commitment products can backfire. I want to put that out before closing. And so to learn more, there's this fantastic summary that was put together by the JPAL financial initiative team. I encourage you to read it. I put the link here. So I'm going to stop here. Thank you very much for your attention. And I wish you a good night or a good day. So long.